Good morning and welcome back to Capital Markets Quickie by MVP Mind Value Partners. I'm your host, Endrit Sella. Today we're setting our sights on the mountains of Jackson Hole, Wyoming, where the central banking world's spotlight is brightly shining. If there's a Davos for bankers, then guys, this is definitely it. Central bankers are convening in Jackson Hole for their annual showdown. With Treasury yields near a 15-year high, all the buzz revolves around Fed Chair Jay Powell's upcoming speech. Will he lean hawkish, or will recent data steer the narrative? Last week's Fed minutes, however, stirred up the pot a little bit, revealing that a majority of Fed officials were nodding towards further rate hikes. So what's their worry? Obviously persistently high inflation. Even though some recent inflation reports hint at cooling, Powell is expected to underline the urgency to bring inflation under control. Just to paint a clearer picture, imagine a boiling pot and Jay Powell's trying to control the heat. Well, obviously, he doesn't want the water to spill over. It's a tough task, guys. It's not that easy. Now, let's decode some nuances. Will Powell give a nod to the recent cooler inflation data signaling a little break, or are we bracing for another round or two of rate hikes? Let's pivot to talk about rates. Here's a simplified breakdown. Nominal yields on the 10-year Treasury have inched up above 4.3%, and once you factor in inflation, we're seeing real yields nearing the 2% mark. If this surpasses 2% anytime soon, it could mean choppy waters ahead for the Fed and choppy waters ahead for the stock market, possibly because it seems that Treasuries are a real alternative for investors. Lastly, even if the Fed decides to hold rates steady, the question is, for how long? We'll keep you updated, guys, so stay tuned and make sure to follow our podcast for more Capital Market Quickies. Cheerio.